Good afternoon and welcome to the Future of Finance Payments webinar. I shall now hand you over to Dominic Hobson and the panel. Thank you.
Hello everybody and welcome to our webinar, Payments, the sequel as I call it. I'm Dominic Hobson, co-founder of Future of Finance. It's my privilege to moderate our discussion today. 9 months have elapsed since we last explored this subject in June last year. Now some things have changed since then, but an awful lot of things haven't. In fact, I sometimes think maybe nothing has really changed in payments at all. As the article accompanying this webinar asked, has payments innovation failed to live up to the hype? And that's one of the questions we'll be discussing today, whether despite all the fintech fanfare and all the money that's gone into reinventing payments, has anything fundamental changed in payments at all? To address that question and many others, I'm joined by 6 people who are far better qualified to answer that question than I will ever be. Chris Hamilton is a financial markets infrastructure expert who's worked in clearing and settlement with the ASX, on the new payments platform in Australia, and with Bank Serve Africa, the largest automated clearinghouse in Africa. Oliver von Landsberg-Sadie is CEO at BCB Group, which provides a range of services to digital asset trading venues, including cryptocurrency payment services. Olaf Ransom is a payments and securities operations expert, currently working with the SIX Digital Exchange. Olaf also worked with the Finality Bank Consortium on digitizing central bank money payments. Claire Rowley is head of business operations at the Global Legal Entity Foundation, GLIFE, which aims to ensure every business has a single global digital identity. John Salmon is technology partner at law firm Hogan Lovells, where he specializes in advising financial institutions on fintech projects. Rob Lincoln is CEO of Paydoc, a cloud-based payments orchestration platform that assists merchants who seek to benefit from the wide range of payments and related providers now in the marketplace. In addition to our panelists, as always, we do of course also have you, our audience, and all 7 of us are going to be extremely disappointed if we don't get lots of testing questions and comments throughout this webinar, which you can submit by using the Q&A or chat functionality at the bottom of your Zoom screens. Rest assured, we will not be saving them up to the end, but answer them as we go along, so that we have at least an unexpected element that keeps our panelists on their toes. So please don't disappoint us. I'd like to begin with the point I raised a moment ago, which is, have we exaggerated the amount of innovation we're seeing in payments? I date the beginning of innovation to the emergence of PayPal about 20 years ago. Since then, it seems we've proved that banks are not needed to make payments. That's something we knew already. We've proved we can pay each other much faster, which I think we also knew already. We've proved we can pre-fund non-bank accounts from bank accounts, which probably wasn't worth doing in the first place. And we've proved we can cut the payments revenues of the banks, which has transferred wealth from one set of intermediaries to another. The central banks are still there, the banks are still there, the debit and credit card companies are not just still there, but worth even more than the banks themselves. And we also have a bunch of fintechs and their investors, which have also become enormously wealthy. In other words, is payments innovation not actually a great innovation phenomenon we think it is at all? Is it just an epiphenomenon in which a lot of clever developers have become enormously wealthy by using the internet to skim off the cream of the revenues of the banks? Rob, perhaps I could come to you first. You're at the heart of trying to turn payments innovation into something which merchants, people actually selling goods and services to the public, can use. What's your view? Are we in the middle of the greatest innovation revolution since the invention of the steam engine, or are we looking at something much more superficial?
Thanks, Dominic, and great to be on the panel with you all. Great to be here. And that's a great question. That's a question that we wrestle with every day, which is exactly that. Is all this boiling ocean of fintech now actually amounting to anything? Who's helping who? Who is benefiting? Who's not benefiting? Who's actually potentially being frustrated? And where is it all going? I think over the last few years, what we've seen at Paydoc is that the boiling ocean of fintech choice has created a lot of confusion for merchants. And as an orchestration platform, we're out there in the trenches working with merchants every day. And if we genuinely ask them, what is the difference between Stripe and Adyen and Rapid and Checkout.com and Authorized.net, and I could go on, there's literally dozens, those merchants honestly couldn't tell you the truth. So a lot of merchants are struggling to tell the difference between, the different vendors out there. And then we introduced to this mix all the alternative payment methods, the buy now, pay laters. We look at what FPOS in Australia is doing with FPOS Online. And if you're a merchant and you're looking at out at this landscape, you don't know where to eat the elephant. And so I think while innovation can be great at a consumer level, often for the merchant, there might be some opportunity dying on the vine because they're not quite sure how to engage it and how to embrace that benefit in a way that satisfies the BAU of the business: reconciliation, compliance, customer experience, just the technical integration points, that's made Stripe so valuable. But I think also, to answer your question, seeing Stripe's recent valuation, it was interesting. I saw a footnote that said that their valuation today is greater than the entire e-commerce industry TTV when they started the business. And I thought, isn't that an interesting little statistic in the FT today, to saying how this space is just blown up? So I think the question is a very diplomatic yes and no. Yes, it is one of the greatest revolutions we've ever seen. There's a lot of very powerful people being disintermediated, and there's a real race to the bottom on transaction fees. But I think the question we should be asking is, how is the merchant picking all this? At the end of the day, is a merchant in the chain, right? Who's taking care of the merchant in all of this? That's a really interesting question. And I think sometimes for the merchant, the answer is it's challenging.
Mm-hmm. Thanks, Rob. Oliver, can I tempt you to think a little bit about that question? I said rather contentiously that a lot of non-bank fintechs are doing nothing except transfer money from banks to themselves. Tell us, do you think genuine innovation is actually going on here or not?
The way, thanks for that, Dominic. The way I like to think about this is, I love Rob's point of view from the merchant solutions and the huge diversity of back-end solutions back there trying to solve the same problems. I'm going to take it from a slightly different angle and draw some analogies with what we've seen with the evolution of goods distribution. Specifically, let's look at Barnes & Noble versus Amazon. I want to look at how other models have been disrupted, public transport to Uber, the hotel industry to Airbnb, and those models. And what I feel is happening is that, we've got ISO 20022 coming in, which is which bears a lot of promise to make things interoperable, build the ultimate network of payment networks. And it is, in my view, genuine technological innovation, which will allow the world payments markets to speak to each other more efficiently. But I still feel like it's an iteration, an improvement on the kind of the 20th century model. And I think much of what I'm going to say today is going to be blockchain flavored. And so where I'm going with this is that I think there's a much more interesting innovation, which doesn't require a consensus of thousands of different banks and central banks in the world to operate. It requires a fundamental shift in thinking, and that the blockchain-based payments networks, which we can go into another point in the conversation, represent that big phase shift from the 100 global payments networks to the single unified decentralized payments networks.
Right, Chris, I was beginning to think that Oliver's been rather conservative there, blowing a trumpet for ISO 20022, but actually at the end he said something rather radical there, which is actually that's, trying to get thousands, tens of thousands of banks to sign up to ISO 20022 is a really hard task compared with what you might do with some of the new technologies coming out of blockchain and the experiments currently taking place in DeFi. What's your view? I can't remember, Chris, whether you're a blockchain bear or a blockchain bull or somewhere in between.
Very diplomatically both, but I'll try and explain that in a second. Let me talk a little bit about the macro picture of your original question, which is, are these innovations really changing the world? And I think there's actually a fair bit of evidence that they are, but to see the really big changes, you've got to look at fundamental network change rather than people innovating on top of the network. Not that there's anything wrong with innovating on top of the network, because it's going to improve things, make things go faster, make them cheaper, blah, 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 all really important stuff, right? But if you're looking for fundamental change, you've got to look for the networks that are changing. And that's where I think the bears, if you like, are pointing at Bitcoin and saying it's not changing the fundamental network. And right now they're right. But the networks are changing. And it's easier to see if you go to developing economies. Why? Because they're cash-based. They haven't yet got a network that's an incumbent, right? So let's have a look. What have we got? We used to have just cards and cash. I'm talking retail payments only. I know business payments, whole different ballpark. Put that to one side for a second. Talking cards and cash. That's what we used to have. Now we have cards, we have cash, we have telco wallets, right? And we have social media. And there are now countries that are dominated by all four of those models. And the banks are fighting back with real time, which is also, in my view, going to become a dominant model in a number of jurisdictions. It's well on the way already, right? So if you want to go and look at genuine fundamental infrastructure change, have a look at China, right? The retail banks in China have, it's sad to say, if you're a bank, lost retail payments to social media companies, to the likes of WeChat and PayPal. That's fundamental change. This is a completely different way of doing things and brings a whole lot of different policy problems for the government there and a whole lot of new issues and new opportunities around that fundamental shift, right? If you want to look at telcos, have a look at Kenya, Uganda, basically East Africa, where again, the banks are not doing retail payments business. The telcos are. Now, these are not technological changes, although they're obviously enabled by technology. What we're seeing now is a fantastic petri dish of experimentation across the world on these different networks. And then all of those big fundamental changes spawn enormous amount of innovation on top of them. Crypto isn't there yet in that conversation I've just given you. It's not that it's not going to be, it's just not there yet.
So just before I let you go, Chris, genuine innovations like PayPal, like Alipay, TenPay, M-Pesa, which you've mentioned, but they leave in some of those countries there was nothing, there was no incumbents for them to displace, was there? So they were pushing at an open door. But at the same time, it hasn't fundamentally changed the need for banks, has it? You still need banks to supply liquidity. You still need banks to supply credit. What can change that is my real question. Can anything?
Yeah, I mean, my answer to that is to say, you actually really need to think carefully about what you mean by bank when you ask that question.
A deposit-taking institution is what I mean, which then lends the deposits to other people.
Okay. But the classic bank analysis is there are four main functions, right? There's deposits, there's credit, there's investments, and there's transactions. Mm-hmm. I'm thinking the payment sense. There are other things that banks do, but that's the fundamentals of it, right? Now, my belief is that the banking world is undergoing its own quiet revolution, and that increasingly those four things won't be done in one place. So what we now all have in our heads as a bank is actually not going to look less and less useful as time goes on, because organizations will specialize into things that they do. Now, the most important thing that we in payments need someone to do is to store value, right? And banks will continue to try and do that aggressively. If you're in a blockchain world, then you can argue that the value is stored on the blockchain. It is stored in the network, if you like. We can get into the details of how that works and how intermediated that's going to be later on, if you like. But fundamentally, we still need someone to store value on behalf of consumers. That's not going away anytime soon, although the organizations that do it might change quite a lot, right? And then the transaction processing, you're right. Don't need a bank to do that. It's easy now technologically to disaggregate that from stores of value and from credit provision. And so that's a big challenge for the banks. That's where they've had most of their trouble, because new organizations are coming in and cherry picking transactions off that bundle, right?
Okay, thanks, Chris. Ola, I'm sure you have some thoughts on this. What's the use of banks? If we get CBDCs, could we just leave the job of that storing value to the central bank? Or are the central banks going to insist on operating through this network of commercial banks? Where's real revolution going to come from here? What's the thing that commercial banks do which is completely unreproducible by anybody else? Is it that deposit taking? Is it that store of value? Certainly, we've seen not that transaction management or that movement of money. What's the
right? Let's start. So, for the financial sector, their job is to move and allocate money and risk. So if I look at it in the wholesale perspective, the CBDC thing could help them on the wholesale side if they don't have to be the correspondent banks and holding balances overnight that we've had to date. So on the wholesale side of the business, big challenge. We leave money all over the place, credit balances, debit balance is, and that's incredibly expensive. We've set that up over many years, so we end up with fragmented liquidity. That's just been a function of the way we've built stuff, because nobody really cared about the plumbing functions, because it's like, yeah, we make so much money, as long as the costs are down here, it's kind of okay. And now it isn't. Now we're not making so much money. So suddenly you're making normal profit, and that plumbing stuff matters, and all that liquidity. So the liquidity part that banks do is extremely expensive. The good folks at Wyman did some work on this, and then the guys at HQLAX, the fintech startup, did an extra test, and they said, well, look, on average, the GSIBs have got 230 plus billion in liquidity buffers, of which 10 to 30% is for intraday. So just to make sure the right amount of money is in the right place at the right time, that's amazingly expensive. So we've got this opportunity now, particularly as blockchain comes along, it says, I'm a clever bit of technology. You could use my bit of technology to replumb the world. We have an opportunity. We don't have to use blockchain, but it's got us all thinking. As we put that together, if we can do liquidity in new forms and connect up securities markets, payments capabilities in new ways, we'll reduce those costs. So to your question, are we there yet? No, absolutely not, particularly in wholesale. We haven't gone there. Yes, we'll see the Chinese do something in retail. I think they'll stick to the two-tier model. I'm not particularly great at the retail side of payments, but it feels like they want to do the two-tier model. I'm sitting in a country that's reasonably advanced here in Switzerland. There's no particular reason for us to have a new payment system. It works, but the Chinese are taking it, saying, look, we can set the world standard. And that's kind of a bit of soft power, particularly closer to where Chris is at home, around Africa. So that's what we might see.
The best we can look forward to, Elaf, is economizing on liquidity costs.
Yes, but just to put this in a little bit of perspective, Uncle Sam still sends checks, right? The most advanced economy in the world, ho ho, sent my son, who's an American citizen, a COVID check, a check. You have to be kidding. 2021, and Uncle Sam is still cutting checks. I was very surprised when this made it to him. The funny thing is, we don't actually know how to deposit those in Switzerland particularly easily. No one can remember.
I had to ask my bank to send I had to find somebody to send a fax to my bank to make my house deposit when I moved.
Yeah,
that tech.
It's a form of liquidity management, though, Olaf, because you can't cash the check. They can keep
fair enough. Yeah.
But guys, it is all about networks, hey? The reason why the US is in such a strait is because it finds it impossible to shift its entire network at the same time. It's really kind of that simple, right? And this is why I say in developing economies where they don't have that problem, you can see some really interesting things being done at a network level, because all they're fighting against is cash. That's it, right? And I think that gives you the clue to where you're going to succeed and fail. Where can you get a big enough network effect?
I think that's a really good point, and it relates to something that you were saying, Oliver, which is it's really tempting, I think, to get on a panel and say, this is the winner, this is the next big thing. And every time there's some announcement about Libra or, ISO 20022 or, there's a whole series of protocols out there. We don't actually know which one's going to win, or in which jurisdiction or which geography, or how consumer sentiment is going to change the way that people interface, whether they're happy to do things on a different kind of ledger through mobile money, who knows? And I think that's one of the amazing things about where we sit sort of at an acceptance layer, the enormous fragmentation. And we're bridging the divide from a check on one hand to something that's blockchain enabled and exploratory on the other hand, and everything in the middle. And I think that's what makes the current situation payment so fascinating, because we just don't know how everything's going to shake out. But at the same time, merchants, in particular, from our perspective, they're wanting to participate, but it's such a noisy, confusing, fragmented, fast-moving space on one hand, and then on the other hand, we've still got checks. I think the last check that I got, I put it on a magnet on the fridge just to keep it there. I'd never checked it. The bank didn't know what to do with it.
We're starting to get some questions coming in now, which I'd like to put to people, but in a minute. Now, Claire, I know that you've been observing what's happening in the shape of stable coins, payment tokens on blockchain networks. What is your view of what contribution they can make to genuine innovation in the payments markets?
Certainly, and I'll pick up a bit on some of the themes mentioned by Rob and by Chris here, and that is, you could say, starting to look more at the micro and how fintech, how innovation is happening there, and then could expand more to a macro perspective. So I agree with Rob's perspective there that there's quite a lot of noise out there with so many choices, and certainly for merchants, it's quite difficult to follow. But if you look at what the fintechs and innovative companies are doing, sometimes in very specific corridors, it really can help to reduce transaction costs for the smaller end user. And just for example, we have some discussions with a fintech, and they're specializing in remittance payments between the United States and Philippines. So there you have a solution. It's a very specific market, but you've significantly reduced those transaction costs for the involved parties. And perhaps just to look at some of the innovation that is coming from the crypto area. So my organization, The Life, we are not payment facilitators by any means, but what we do is we provide a network of global and recognized identity for legal entities. And so specifically in the emerging area of cryptocurrency or other assets, this is a very important aspect, identity. So you could say it is something that slows down existing payment networks, especially in cross-border payment networks. How do you know that the originator, the beneficiary, who they are? How can you conduct your sanctions screening in an efficient manner? And you see now, as cryptocurrencies are coming more mainstream, this very same dialogue happening, again, just for a different type of market. And so certainly I believe that cryptocurrencies, they have a valid role to play, and sometimes it is to maybe assist with that liquidity buffer, because you have certainly a larger peer-to-peer network for common exchange unit. But where we focus a bit is looking at, well, how can you be sure that these exchanges are secure and transparent, and also done in a way that doesn't replicate some of the drawbacks of today's payments infrastructure? So high cost, lack of standardization. And that is where you will find the LEI, the legal entity identifier, entering the conversation as a means to identify the different parties involved in payments transactions, and to act as a global standard to help to facilitate network interactions such that the costs ultimately can be lower. And I think that's where you will see the success coming as cryptocurrencies or other digital assets grow, because they have to be lower cost. They can't replicate the problems of current systems, of current exchanges. Otherwise, ultimately, they will come to a dead end very quickly.
Okay, thanks, Claire. I'd like to read out an observation made by Nick Ogden, who's a member of our audience. Financial innovation always happens post a crisis. Given that we're in one, and there's been substantial transformation in how we all work, and with the arrival of a new global LVL network, what happens next? Considering that LVL collapses all payment types into a simpler, open digital environment operating 24/7 by 365. Now, John, you've been very patient. I'd like to bring in, you're working with fintechs. You must be seeing at firsthand some of the things they're trying to do in terms of payment tokens, cryptocurrencies, central bank digital currencies, programmable money. We had a whole webinar on this a few weeks back, which seemed to boil down to conditional payment was all it was. What's worrying me about everything I've heard, with the honourable exception of Oliver here, who's going to explain to us the new paradigm, hopefully in a minute, all we can look forward to is lower liquidity costs and cheaper and faster payments. What are you seeing that presages a genuine innovation revolution in how payments are sourced and made?
I think it is what the other panelists have said, Dominic, which is, and maybe a point to kind of re-emphasize, is that innovation, to some extent, if taking out the blockchain stuff for a minute, is curtailed by the fact that most of that innovation is built on existing payment rails, right? It's the point that Chris made about infrastructure and networks are important. Is if you've got the existing infrastructure, there's a limit to what you can do. M-Pesa is different, obviously, because it didn't use any network infrastructure. That's a good example of something where the infrastructure wasn't used. So if we go back to using some sort of crypto asset infrastructure, then CDBCs, I do a lot of sessions on CDBCs, etc., for governments and policymakers around the world. And I think it is, if you look at particularly what Sweden's been looking at with e-krona, Sweden's got to the position where they are worried about the decline in the use of cash has got to the extent that they're concerned that people will not be able to pay using cash. And if people can't pay using cash, that basically takes the lower strata of society potentially out of being able to pay for things. So they want to introduce what they call e-krona, which is basically a state-backed digital currency. And I think a state-backed digital currency could completely reinvent the payment infrastructure. Yes, if you look at it from a UK perspective, the Bank of England, no doubt, would look after that, and there would be lots of regulation, et cetera, et cetera, et cetera. But it could completely reinvent the network infrastructure and the rails upon which payments would be made. And that would really lead to a lot more innovation, I think, in the space. But it would also lead to, the points that others have made around, it wouldn't just be retail, it would go into wholesale, it would go into clearing and settlement. There would be a lot of ripples of innovation through that. And certainly from my perspective, if we look at from a societal perspective, from a financial inclusion perspective, then I think CDBCs have its attractions, because do we want to be at the behest of a big tech company owning potentially a digital currency that we all end up using, or many people in society end up using, or would we rather the government? I mean, discuss, right? I suppose it depends on your view on government, but I think that is where innovation is going to come in, Dominic.
Okay, yeah, well, we do discuss CBDC. We've discussed it 3 times already, and I'm glad you think it's going to be a source of innovation here. But the problem we face still is that actually making payments is incredibly expensive, despite everything that's happened. It's $1.5–2 trillion a year on the global economy. It's $1,000 a head. We're eating, 2 or more than 2% of global GDP making payments. It's clear this could be made a lot cheaper. So, Oliver, perhaps this is the moment for you to share with us your new paradigm based not on banks and ISO 20022 and existing networks, but something completely different, which will get that 2% of global GDP down. What's your vision?
Dominic, I wish more people appreciated the true cost of payments. What's so obvious and visible to people who are skeptical of the cryptocurrency market is the cost of mining Bitcoin. It's such a big salient number. You can observe it easily. It's so easy to calculate. And when it costs £5 to send £5, people scratch their heads and think, how's this ever going to replace the existing system of stores of value and methods of payment? And so the counter example right there is, of course, the incumbent network. I mean, the existing global infrastructure of payments costs a hell of a lot of money, and that really needs more prominence. But I think that gross difference in price for the cost of a transaction is directly proportional to how inefficient the existing market is. And for me, the paradigm shift that sold me out of 20 years in banking and into this whole funky fringe blockchain space was, in this blockchain space, there is a single source of truth that 10,000 nodes can agree on, whereas in the existing payments network, 10,000 correspondent banks and their Nostro and Vostro account have to agree with each other. That reconciliation process itself is, adds cost and inefficiency, and at the risk of oversimplifying the paradigm, but that is it. It is 10,000 truths or a single truth, and the efficiency of generating and replicating that truth across a decentralized network is actually a tiny fraction of the cost of maintaining 10,000 truths.
But correspondent banks exist for a reason. if I want to send $10,000 to New York, I don't actually send $10,000 to my bank in London to a bank in New York. An arrangement has to be made, but somebody needs pounds in New York, and the bank arranges for my dollars to be given to them by a sort of book entry system. You think that a blockchain network can replace that structure, do you?
I do, because on a blockchain structure, the value exists on the network and it is being physically sent from one identifiable address to another. And there is no need for any kind of RTGS or net settlement at the end of the day to true that up. It is now.
I agree with Oliver. I think it is, and part of the reason, Dominic, and again, I think I agree again that it's helpful for you to call out the cost of payments. But the reason that there is a cost of payment is there's big trust and regulatory issues in this. If people make a payment, they want to know it's getting to the right person, right? I mean, that might sound totally obvious, but I mean, the reason, there's still lots of people don't trust digital payments at all, so I think it is. That's, and there's a very expensive infrastructure being built around that over a long period where there was much more clunky processes. So, and I think just stripping all that away and using blockchain would really, reinvigorate all all of that.
Okay, Claire.
I'd say there's an access question there as well, because to the thing that Oliver started with, or which is what Dominic started with, if you're in the UK, your bank may not have the ability directly to process dollars. If it was able to hold some dollars for settlement purposes, it would make that payment on a peer-to-peer basis, even to the other bank that's receiving it, and they'd credit John's account, and John would be happy in the US, and there would be fewer intermediaries. But it's actually the rules from the regulators that say who's allowed to play in the different payment systems, and those were rules that were probably seemed okay when we wrote them several eons ago. And on that, we've now, to Chris's earlier point, we've layered tiers of correspondence into that, because that's just the natural outcome of the restrictions. If, as we have this moment to use blockchain technology and DLT, and we're thinking about what we're doing, if we can change to peer-to-peer, and even if you keep the banks in the picture, but if you can make access to payments balances easier for settlement purposes, you will free up swathes of things, and have a better arrangement between the foundations and the layers on top, as Chris described them. So I think we have an opportunity, particularly in wholesale, where the numbers are big, the overdrafts are huge, the liquidity costs, as I quoted earlier, are absolutely enormous. We can do it. We have a chance to build for better.
Okay, thanks, Olaf. And I'd like Claire to think a little bit about that trust question that John has raised. Before you do, Claire, I'd like to stay with Olaf. There's a question raised here by Eugene Kemp, which is, does SWIFT and ISO have a part to play in wholesale change on the horizon? The legacy conundrum is huge. Interoperability, standards, compliance, and cross-border efficiencies are critical. How do we transform without rip and replacing? Now, the reason I think that's relevant, Olaf, is while you were talking, I was thinking, well, the regulators have set up this system where they decide who can play inside the RTGS system in each country, for example. So what if we had a system, to address Eugene Kemp's question, where RTGS systems could link directly? Could you get rid of correspondent banks? Is that even possible?
You could get rid of some of the functions of a correspondent bank. So Credit Suisse down the road from me right now, they sent 1,000 payments over to Bank of New York and said, make these for us on value date Tuesday, please. And they get paid $1 a transaction or whatever it is. That piece could go away. But Credit Suisse would have other reasons for keeping a relationship with Bank of New York, because actually what they really want is they want liquidity. So they might actually go in the future, if you had wider access to either CBDC or a private equivalent like Finality, you could go into a trading screen and say, hey, I'm Swiss Bank, I got some Swiss francs, I need dollars. Who's got dollars available now? And you trade liquidity. So I see there the correspondent banking department making a couple of payments. Perhaps tomorrow they don't do that. But the role for the banks to provide liquidity, absolutely, but that's what they're there for. allocating and moving money and risk. That's a good thing. Nothing wrong with that. But everything wrong with being in the way of the individual payments and all the delays that go with it.
Yeah, we are talking here about cross-border payments, which are particularly excruciatingly painful form of payment, but domestic costs are significant as well. Now, Claire, the point that John raised about trust, one of our favorite solutions to this at Future of Finance is digital identities, to try and get rid of those KYC, AML, CFT sanctions screening costs, which is work which banks do to make sure that the payment you're sending is from the person who says it comes from and it gets to the person who they'd like it to get to. Is there a technological answer to cutting those costs in the same way we can cut liquidity costs and transaction costs?
Indeed, and also I just want to speak a moment to the part of the question about legacy systems and the difficulty of updating those. The Financial Stability Board has published a series of reports about cross-border payments and how to improve some of the efficiencies there. They look specifically at the high cost, the low speed, limited access, and insufficient transparency. And you see there that indeed around the topic of identity, which is the core of the trust, you are looking at still reliance on manual processing, a variety of identity schemes that are used throughout the world. And digital identity is indeed a solution to that. So instead of passing around payment messages which have text interpretation of names, relying instead of identifiers that are machine readable and don't have the complications of, for example, translation, transliteration, different character sets. But of course, a very key aspect to digital identity is you need to have a cryptographically bound identifier with a physical entity. And that can be done through, for example, products like digital certificates, or if you're looking more a bit future oriented, and especially in blockchain networks, the topic of credentials. That's the idea of having a wallet where a user or a participant in a network can present certain credentials that are, again, cryptographically tied to that entity that give you the trust factor that indeed you're interacting with an entity who it says it is. And that, of course, would bring down greatly the topic of KYC, AML sanction screening. So if there was a way in the cross-border topic to reliably, in a completely interoperable global way, understand who is the entity that I'm dealing with on the other side, that would greatly facilitate, first of all, that basic step of creating an account. So your KYC, your onboarding, the due diligence that is required to understand better if I focus on legal entities only, just where this entity is incorporated, the basic details of it, and then facilitate much more, you could say, machine processing of transactions rather than what we have today, where transactions are interrupted for manual intervention due to sanction screening. So indeed, we see that digital identity and the progress there, it will impact both worlds. It will impact your traditional world, as we see that regulators around the world are focusing on this, especially in the COVID times, to how can I improve my existing processes, and then absolutely for your emergence of networks, where the basic question of what are my credentials to sign onto this network, that is directly at the heart of digital identity.
Mm-hmm. Chris, thank you for that, Claire. Now, to some extent, the whole digital identity thing is a data problem. It's about sharing data between the parties to a transaction. But if we also pick up the questions that Nick Ogden and Eugene Kemp have been asking here, there's an expectation among members of the audience that there needs to be some innovation here, and they're wondering still where it's going to come from. The crisis is a great opportunity, says Nick Ogden, and Eugene Kemp is asking us, well, where are SWIFT and ISO 20022 in this? Oliver's mentioned that. So as you look at this, Chris, as a data exchange problem, is the answer here, I think it's the question SWIFT would probably ask, is the answer APIs or is the answer blockchain networks? Can these two technologies work together? You're on mute, Chris, I think, so you need to unmute yourself.
I'm sorry, there we go. They can absolutely work together, but I want to, before I talk about that a little bit, I want to take a step back and just bring in the different elements of that picture. Let's start by making an assumption, and I can only really assert it here rather than prove it, that if you have a universal network for any community that wants to do payments among itself, that is going to be fundamentally cheaper, orders of magnitude cheaper than a non-universal network with complex interoperability, right? And so the simplest way to get payments costs down enormously is complete global domination by one network, right? Now, as soon as I say that, you start to see where I'm going with this, right? That's probably not something we want to see happen for other reasons.
DM.
Right? Particularly if it's a commercial organization whose credentials are not completely spotless, right? Without mentioning any names. So therein lies your fundamental problem. There's no doubt that getting everybody onto one network, whatever the format is, and here I'm a little bit of a blockchain bear because I'm not convinced that it's the blockchain which is causing the fundamental benefit. It is the universal network effect that's causing the fundamental benefit, right? There is one caveat to that, which is what people like to call, used to call smart contracts. Oliver can probably talk about that a little bit more later on. Programmable money, I think, is a phrase you've used as well. That's a really interesting topic, and there is genuine innovation there, but to one side. It's getting the network effect to work that is going to bring by far the biggest benefit. Trust is an element of that because everybody who's allowed to play on the network has to be qualified to play in some way, and that is your digital identity. That's your trust credential presented to the network, right? And how you do that, there can be very, very many models. But again, the more universal the model, the more powerful the network effect and the cheaper the whole thing's going to be, right? Our problem right now, and I didn't really appreciate it living in Australia, which is one country on one continent, on one island, right? So you can organize things the way you like. In Africa, 55 governments, literally tens of thousands of languages, an enormous diversity in the way people want to do things and who they want to relate to and how they connect. So you can see that the networking problems in Africa are diabolically difficult, right? And so that's really brought it home to me that we have to do something about solving that. And it's actually a social problem, not really a technological one, right? It is how do we all agree that we're going to do things a certain way? If we can get that, we can really bring the costs down a lot. Now, so if you step back from global domination by one entity and you go, okay, we don't want that for a whole lot of other political reasons, what's the next best? Then very high interoperability between strong networks is your next best thing. And that's where APIs come in because they offer the opportunity for very highly functional networks that bind a particular community together to interoperate that community with another community. And they offer that in an efficient technological way. So, and I got to say the blockchain that underlies Bitcoin is not necessarily great at this as my understanding. I'm not a technologist, but having looked at this for a while, but later versions of blockchain seem to have grabbed onto this and have a great deal more potential in terms of interoperability. If you can give each community that wants to pay mainly among itself, but a little bit to other people, if you can give them a really strong network solution, blockchain or not, plus the opportunity to highly interoperate with the next guys, you probably got the best real world alternative that we're likely to have. And, we can see this in the political sphere as well. The various attempts towards common currencies across countries, towards common sets of payment standards across countries are really an instance of this. How do I make interoperations between these different networks work as smoothly and as cheaply as possible? Sorry for the really macro answer, but that's kind of how it
Robin, in fact, to address a point raised by Nick Ogden now, but before I do, are you saying, Chris, that APIs are an alternative to standards? Are APIs an alternative to ISO 20022, to the problem that Oliver referred to? We're going to get 10,000 banks to sign up to a global standard.
Yeah, so in one sense, I would agree that APIs are an alternative to ISO 20022. ISO 20022 is an intra-network solution to standardization, right? APIs don't assume that all the networks speak the same language, right? The technology allows different networks speaking different languages, and ISO 20022 you can think of as a language, right? to interact efficiently or relatively efficiently. But of course, that brings you a new meta standardization problem, which is what is the standard for the API? And there we get into another interesting conversation. But if you want a classic ISO/22 network to talk to an Ethereum network, you can do it, and you can do it with APIs, as I understand the technology.
Right. Now, Rob, could I throw some comments by Eugene Kemp says digital wallets, digital ID, blockchain, does it not synergize the whole cash payment and security settlement for banks? Today, we operate very siloed in this space. It's what we've just been talking about, really, is how blockchain APIs and all the national differences, which Chris referred to, work together. But the more important question I'd like you to think about, Rob, is Nick Ogden's point. It's not the technology, it's the level of service for the customer that matters. You have to mix appropriate technology to deliver super customer satisfaction. Because we tend, working in the financial services industry, forget all about the retailers and the shops and the people, actually the merchants dealing with the public at large. None of this matters to them. They just want to collect payments and make payments efficiently, don't they? So are we creating a world of customer dissatisfaction with all this assets innovation that's going on?
Well, I think we're creating a world where customers demand freedom and flexibility and choice. And we certainly don't want to create a point of sale that's, got 25 QR codes on it. Or, we've seen merchants with multiple different points of sale, and then we've got wallet-based solutions, etc. It does get very confusing for the merchant. I was reading Eugene's comment here and then reading Nick's answer and thinking about the relationship to the two of them. And I think, Chris, you said it well, interoperability is the word. We're stuck, for better or worse, in this system where there's so many different things going on. And it's exactly right. You need to mix appropriate technologies, just as you said, Nick. That's what we're seeing on the field. That's what we're seeing coming back from the retailers. They say, look, this is great. I have this thing with, acquirer A and acquirer B, but I also need to be able to do C, D, E, and F. And I need to be able to plug things on and off as I choose in a way that doesn't cost me a lot. And I can't pick a winner today because the space is moving so fast. So customer satisfaction is great. But if you're moving the dial by like 0.5%, but it's going to cost you 200 grand to do it, you're just going to leave that opportunity behind. And I think when we're seeing emerging technologies like here in the UK, we've got people like TrueLayer and Tink and others doing a great open banking technology. We look at what Visa was seeking to do with Plaid in the US, and we look at what FPOS is doing in Australia, least cost routing, particularly digital least cost routing, and what's that's doing in Australia. Fascinating, amazing dynamics. And I think there is a genuine race to the bottom. Personally, that's my belief. That's what I'm seeing play out in the market. There is a race to the bottom on transaction acceptance fees as well. So it's both driving the needle on the customer satisfaction side in a way that doesn't cost you an arm and a leg and take 12 months to bolt on one new fee, one new vendor. And on the other side, merchants saying, well, actually, I can see over there, I'd save a lot of money, be a lot cheaper. And I think one of the really interesting things that happened in the market here was with MasterCard's announcement to increase interchange outside, coming for funds transferring out of the UK. Very interesting thing. And so merchants are saying, well, look, that was another change in the market I'm exposed to. I wish I had an interoperable approach to the market to enable me to mix and match my payment strategy to stay aligned with the times. So I think this is obviously, in my job, but I feel like this is a theme that's not going away anytime soon. And you have to mix the technologies, as you say, Nick, but I think the real question is how are you going to do that? And so I think a lot of people say, well, it's going to be ISO, it's going to be this, it's going to be that. But Chris, as you say, that's going to be wrapped around APIs, and people are going to have their own interpretations and value adds on those APIs, and they're going to write their own standards. And so the game continues. And then will that increase the cost of acceptance on what, in an isolated instance, may be quite a cheap point-to-point processor, but quite an expensive experience for the merchant? We don't yet know, but it is very early days for a lot of these technologies, that's for sure.
Just want to tack on to that, if you don't mind, Rob. This is based on your comment about, how do you actually mix those technologies and deliver that customer satisfaction. And this is not really to add to that point, but really a shout out of fandom to Nick Ogden and what he's doing at Clearbank, because I think they do absolutely nail it when it comes to presenting a unified API that handles a whole bunch of mixed technologies in the back. And while I'm expressing fandom, let me also say how much I respect the LEI initiative, which again, it speaks to the single source of truth that we really need to glue all of these networks together for that truly global interoperable thing. And for anybody who thinks I'm a blockchain extremist, I'm not. I think the solution lies squarely in the middle of the blockchain world and the existing infrastructure, and initiatives like Life, if that's how you pronounce it, address that squarely.
A blockchain pragmatist, isn't it?
Oliver, can I just, one thing that's puzzling me here is that we've established, I think, through the course of this conversation, we need banks, and we need banks because of liquidity. We can make that liquidity cost a bit cheaper, but we also need banks to extend credit. People don't always have the money to make a payment; they need to borrow it from somebody. And we need a system which enables them to do that if money is going to continue making the world go round. And no matter how efficient we make the networks, which Chris has referred to, and maybe we get down that $1.5 to $2 trillion a year cost down to something through the use of blockchain or APIs or some other technology, that fundamental problem of, not a problem, that fundamental need for a banking system to support payments doesn't seem to go away under any of the scenarios we've discussed. We've talked here just about cutting transaction costs. We haven't talked about fundamentally changing the system by which payments are made.
I don't think banks are ever going to go away, but that's because, as somebody neatly expressed, was it Chris or Rob? I can't remember.
Probably Olaf. He's very good on that.
Yeah, they're very, banks have 4 distinct functions.
That was Chris. Yeah.
Deposits, credit, transactions, and the point is, I think the longevity of banks will always be in that space of deposits and lendings, deposits and loans. But the payment space, I think, can be independent. But in the fullness of time, and this is where I do go a little blockchain extremist, I think we will see a flip between where the current global reserve currencies are in predominantly USD, but also a smattering of euro and other big national currencies, will flip into a cryptocurrency, TBC, at which point do you need the banks? Because the value then is not a promissory note with a central bank, but it is a different kind of consensus of value.
Okay.
Yeah.
Let's read out an observation by Peter Davey: cross-border payments and transfers and sanction screening requirements. He says these are requirements on PSPs, payment service providers, and VASPs, not central systems like RTGS systems operated by central banks. The key issue is that need to cater for screening data to pass separately from individual payments, but linked with the payments. In other words, that identity piece needs to be linked directly with the actual payment, which I guess is what transaction management platforms like Swift GPI are sort of moving towards. So you get the benefits of netting and aggregation, which you can lose in, I guess, in gross payment systems. So regulators need to cater for the flexing of wire transfer regulations and the travel rule.
Dominic, I think there is some flexibility needed in there, because depending on how you set up a blockchain, too much information can be a dangerous thing, and if you share too much. So fundamentally, and this is something my former colleagues at Finality looked at, if you make a payment on a peer-to-peer network, how much do you want to disclose? And the simple way of looking at it is you probably want to send the details about who sent it and who the ultimate beneficiary is separate from the movement of the money. So as we adopt blockchain or any other technology, we just need to think about those two components. There's the movement of the money, and there's the information to do the right thing with know your customer and all the rest. They don't necessarily have to be on the same network. We can separate those things out, and depending on what kind of blockchain you might want to use, if you indeed want to use blockchain, that is probably a good thing. Would be a quick summary. And Peter is right in his observation from his comfy armchair about that one.
Yeah, I think that's right, Olaf, and that does also link into privacy as well. Because what you don't want is to see the same, even if you see the same public key always coming in the different transactions, and that's enough to put it into personal data, which creates its own issues.
Well, okay. So, but let me take a swing at that from the regulator's perspective for a second, because if you talk to central banks, they're listening to the same webinars that we're all listening to, right? And so they're going, so you mean to say instead of demanding detailed reports from the banks that they try very hard not to fill in properly, I can just connect up my API to the central network and suck the data out in real time, and then I can relieve them of their reporting obligations because I'm getting the real juice here, right? So I think this is going to be an area of massive development for regulation in the next few years, because they'll unavoidably get onto that and start saying, hold on a sec, we want the stuff straight out of the network, right?
It is massive.
No, you can have everything. They'll go, okay, let's work out what you can have, so that's a whole change to the way regulatory reporting happens right now.
It's a massive issue, Chris, and I think that's why people are concerned about CDBCs in China, right? Because of privacy concerns. But that balance, getting the right balance to privacy, but also anonymity, and the fact that we will want to combat AML and CTF and all these things, I think you're quite right. It's a huge issue, and the technology in a way is the easy bit, right? It's actually what the public policy considerations are the hard bit.
That's exactly right. But it's going to change for sure.
Yeah. Peter Davies says, Chris, exactly my point. South African demand for item by item data with each individual payment was a massively retrograde step. Now, unbelievably, we're down to our last 4 or 5 minutes. Time has always flown by. And I'd like to sort of ask each of you something. And Denise Robles has given us quite an interesting way into that. She says, I love blockchain and APIs, but as a customer, I can pay anything around the world with PayPal. So what's going to be the difference if a new platform is created? So perhaps each of you could think about what the answer to that question is. Is this ever more efficient solutions to the problem of efficiency in making payments that we're aiming at? We're not changing anything fundamental. But I'm wondering if I could ask each of you to give me some idea of what you think would be a truly revolutionary change in both domestic payments and cross-border payments, or either, if you like, just something which is really going to change the way we do things and get that $1.5–2 trillion cost, which is lowering all our standards of living. So continual tax on global trade, how we get that down to a sort of nugatory level. And I wonder, Chris, if I could start with you, because you've got a long experience in market infrastructures, payments market infrastructures. Are they an important part of the solution here? Can they provide this network of interoperators, network of networks, using APIs that enable true innovators in payments to run around on, creating lots of interesting but very low cost money transmission services? Are infrastructures somewhat unexpectedly the answer here?
Yeah, they can. Whether they will or not is going to depend on a whole lot of factors, including the regulation in their jurisdictions and so forth. So there's a lot of complexity there, and some will do it quite well and some will do it very badly. But I think a perspective to have, because we're living in the real world rather than the magic wand world, the perspective to have is that the legacy market infrastructures are engaged on a multi-year step change exercise right now, going from batch-based solutions to real-time solutions. Now, we haven't had time to talk about real-time today, and that's fine. Real-time's not about being fast. Real-time's about fundamentally re-architecting the infrastructure, right, if it's done properly. And all of the modern versions of real-time innovation in market infrastructures around the world are actually about making them work in a digital world. They're not really fundamentally, or at first point, about being fast, right? So it's very likely that a good selection of those are going to come through and enable banks and non-banks to innovate on a new platform for quite a long time into the future. And if they do that well, they're in good shape because they are the incumbent network, and network effects rule our world, right? That's the way it'll be. Where that isn't there, because the world is still cash for that economy, or because the market infrastructure really drops the ball, then there are these really exciting innovations in blockchain and in new types of networks that are coming through and can replace those things. So my view of the world is the market infrastructures have to step up to do this interoperability and to enable this new level of development. The technology is all there. It's purely a political and social problem right now to get those costs down and to make the thing more efficient. And the guys that do it well will have the benefit of their network effect behind them. And the guys that don't are going to have some pretty interesting new technologies sorting them out.
Mm-hmm. So Claire, is this an area for Glyph to get involved in, trying to encourage that interoperability between national infrastructures?
Absolutely. Muscular regulation is going to be a necessary part of this picture, I'm afraid.
Mm-hmm.
And I was going to pick up exactly on some of Chris's earlier theme, that idea of interoperability. And if you think of the future of either your traditional payment infrastructures or more innovative, let's say blockchain networks, and you start with the basic question, how many identities do we all on this conference today have, or any individual business? And the reality is hundreds.
True.
But why is one, for example, as Denise has highlighted, her PayPal identity? Why is that more important? It's because of the network effect. It's because of all the merchants, of all of the different options that are available to her to make a payment through PayPal. But as Chris pointed out, well, if someday that account was deactivated because PayPal's a private company and they have a policy and they choose to do it, that's a real problem for the user of that. And I do think that whether it's looking at the traditional, your market infrastructures, or the emerging different networks for payments, the focus either from a consumer or from a regulatory perspective really should be around interoperability, so that consumers do have the ability to move from one to the other, to move from an innovative world to a more traditional world where they could cash checks that come from the US government in a seamless way without having to manage themselves hundreds of digital identities, which all have different levels of trust from the recipients.
Mm-hmm. Thank you, Chair. So Oliver, you've heard both Claire and Chris talk about this is not just a technological choice we need here. Actually, it's more complicated than that. There are political, social, economic choices to be made as well before we arrive at a better global system of payments, and cheaper one as well.
Right. I think those points are hugely complementary, and I have nothing fundamental to add other than that. I think part of the key, did you say Olaf or Oliver? Is destigmatization of the blockchain flavored projects, and the education curve required to see how those how those blockchain and even some kind of semi-blockchain solutions like Corda address those problems.
Mm-hmm. Okay, John, destigmatization of your clients' work would make a big advance in making payments cheaper, faster, better.
Yeah, I mean, it does come down to the policy considerations that we talked about earlier, Dominic, but also one of the challenges about doing this on a truly global basis is, while we might have a relatively consistent view for something like AML and CTF, the culture and regulatory infrastructure of a country is quite important to that country. And, the US have quite a different view from us in Europe versus Asia. What's acceptable in China will not be acceptable here. So it's quite a challenge to say, let's have a global system that everything works in the same way and that is acceptable politically, socially, etc. to everyone. So, got to take these cultural norms and regulatory. I mean, that's what I find, all the time trying to do these global projects is, sometimes it's an accident of history, but often it's a lot more deep rooted than that.
Mm-hmm. Yeah, every country has its payments culture. There's no doubt about that. So linking them up is going to be very, very difficult. Now, Rob, you've been very articulate this afternoon on, the other half of payments, the cost of actually acquiring people to use all these solutions, and there is a risk there that we end up with this race to the bottom, as opposed to settling upon the optimum global solution. What's your vision, I suppose, of what would constitute not just radical change in the global payments markets, but actually the most useful and most valuable change?
Thanks, Dominic. I think the word I've heard the most today has been interoperability, and along with that, I think comes an abstraction opportunity and a repositioning of the trust anchors and a move towards identity. I think that's going to be a very interesting space to watch, as we start abstracting away the payment instrument from the identity and we'll see more and more digital identity platforms start coming to prominence, but they're going to need to sit on the back of some payments infrastructure. How does that relate then to blockchain-enabled solutions? I think that's going to be a very interesting space to watch. I am concerned about the race to the bottom. Are we going to see massive VC-funded, subsidized payments running through some of these big, payments businesses for the next few years before everything shakes out? We don't really know. That's going to be really interesting to watch. But I really agree with all the sentiments that have been, expressed here, from interoperability. And, in my mind, immediately I go interoperability, abstraction of the payment instrument, introduction of more rigorous identity opportunities, and shifting trust anchors. And that relates obviously to the banks and then to civil institutions. And I think that's an absolutely fascinating space. Maybe we should do a session on that one day. But that's my guess for now. We'll dig up this recording in 10 years.
Thanks, Rob. No, we will definitely be coming back to this subject. Don't worry, we're only scratching the surface. Olaf, perhaps you could see us out of this session, but we're going to have to stop in a minute. Give us your vision of a payments market, the ideal payments market of the future. Is my thought that the infrastructures have some role to play here in creating the network of networks Chris has referred to a plausible one, or are those national differences, which John has referred to so eloquently, an obstacle in the way of that?
You absolutely will need a network of networks. If I think of the wholesale side of the house, we have securities, we have cash. They're in different places. As we explore the use of blockchain technology, it's very likely now we have more private tokens on more private networks. So the wholesale side definitely needs to solve for the network of networks problem and interoperability that's there. I think the cash side is the big enabler. If I look at all the things we're doing at the SIX Digital Exchange, we look and go, if we can solve for money, the payment part, we can solve for many other things. Not the payment part to make a payment as you might do to a merchant, but the payment part that's attached to a cross-border securities transaction, the payment part that's attached to settling a foreign exchange transaction. So yes to network of networks, yes to interoperability, and yes, we need some new form of payment, be that CBDC or its private equivalent, as long as the risk is the central bank equivalent. So those three components.
Okay, thanks. In fact, we've got a session coming up, I can't remember when it is, the next month or so, on security tokenization. So we'll be looking at the cash leg of securities transactions and how that might drive rapid growth in the security token market. But sadly, I think we must stop there. As I said a minute ago, I think we've really only scratched the surface of this subject, as always. I'd like to thank our panelists, Chris Hamilton, Oliver Lontansberg, Sadie, Olaf Ransom, Claire Rowley, John Salmon, and Rob Lincoln. And I'd also like to thank our audience for your interest and especially your questions, comments, and observations. Our next webinar is a week tomorrow on Wednesday, the 24th of March, a slightly different time of 1600 London time, to accommodate our panelists in California. I don't want them to get out of bed too early. In it, we'll be discussing the topical issue of the growing institutional interest in investing in cryptocurrencies. So if you can join us then, please do. But for now, it's goodbye.
Thank you for joining us. You can find this discussion on www.futureoffinance.biz and indeed other planned webinars under current events. I am Wendy Gallagher. If you would like more information about how to work with us, please do email on wendy.gallagher@futureoffinance.biz. Thank you once again.